January 1, 2003. The Real Estate Capital Scoreboard January 2003. Rates closed at near record low levels not seen since October. In December, the 10-year Treasury dipped nearly 50 basis points as investors flocked to bonds as a safe haven from the stock market. In contrast to a year ago, rates are more than 1.25% lower, before adjusting for spread reduction. In summation, rates remained at historically low levels not seen in about 40 years. Continued downward pressure on capitalization rates draws peak prices for certain property types, particularly apartments. Low-priced debt available from the agencies, limited new construction and pent-up investor demand are key factors in pricing readjustments. February 1, 2003. The Real Estate Capital Scoreboard February 2003. During January, 5 and 10-year Treasury rates moved as much as 40 basis points. The year began with the lowest rates, 3.85%, and settled near 4%. Overall mortgage rates and spreads remain relatively unchanged as loan quality underwriting overshadows rate competition among funding sources. Federal Reserve policymakers voted unanimously to keep the benchmark interest rate unchanged, counting on lower borrowing costs to lift the U.S. economy. The last Fed rate cut was in November, representing 12 consecutive cuts dating back January 2001.
March 1, 2003. The Real Estate Capital Scoreboard March 2003. Short-term banking rates remained unchanged from January, mainly LIBOR and bank prime. Additionally, overall capitalization rates and underwriting metrics also remained relatively stable. In other words, short-term loans are at just under 4.5%, and longer-term debt is about 1% higher. Overall interest rates are at their lowest level of the year, with mortgage rates hovering near the 41-year record low level. Throughout the month, government Treasury yields have been dropping to the tune of about 25 basis points. Since short-term rates remain unchanged, the gap between floating and fixed-rate debt continues to narrow. More demand for fixed-rate debt is expected under these circumstances. April 1, 2003. The Real Estate Capital Scoreboard April 2003. Fierce competition among lenders within the real estate capital arena drives spreads to extremely thin levels. Prime quality properties fetch pricing within the low 100 basis point level. Beyond any doubt, rates are at optimum levels for borrowers seeking acquisition and refinancing funds. During the last week of March, the 10-year Treasury dropped by the largest weekly margin since July, as uncertainty looms for how long the war in Iraq will continue. By the same token, the Fed decided to leave interest rates unchanged as the last adjustment occurred in November, a 50-point drop. Longer-term Treasury spreads are at their lowest levels since 1958. The spreads are converging closer toward short-term indices. The crossover point for locking into fixed-rate mortgages is now very attractive. May 1, 2003 The Real Estate Capital Scoreboard-May, 2003. April was a somewhat calm month for rate movement. Rates settled slightly higher than a month ago, by about 10 basis points. Overall fluctuations within the month were within a 25 basis point range. Rates are trending slightly downward as a result of an uncertain economic outlook. For example, the 5-year treasuries are nearly identical to February levels, the lowest point in the market. Financing demand is steady as spreads remain unchanged with most lenders. Key underwriting variable focus on overall market strengths and borrower equity. Lenders prefer offering lower rates in lieu of more proceeds. June 1, 2003 The Real Estate Capital Scoreboard-June, 2003. Throughout May, rates fluctuated by more than 50 basis points. However, rates continue a downward trend. The supply of funds for mortgage and equity placement is nearly bottomless. Spreads are also at historical lows. Low leverage loans will attract pricing spreads below 120 basis points over comparable term treasuries. Lenders still favor multifamily properties, yet retail properties are rapidly gaining attention as a preferred property type. Office and industrial property financing opportunities are sought depending upon credit, leverage and borrower background. Hotel and healthcare funds remain selective.
July 1, 2003 The Real Estate Capital Scoreboard-July, 2003. June was a very dynamic month as treasuries gyrated by nearly 50 basis points and finished about 10 basis points higher than May. Yet again, such pricing metrics flirt with all-time low levels as Wall Street favors real estate debt. All indications are for a continued favorable long-term mortgage lending environment as the Fed dropped their rate for an unprecedented 13th time since 2001. Hitting a 45-year low. August 1, 2003 The Real Estate Capital Scoreboard-August, 2003. A major review of interest rates demonstrates that longer-term treasuries bounced as much as 130 basis points, currently settling at levels seen in February. The supply of mortgage market monies remains at full capacity. The most favorable index, by far, is LIBOR, which steadily dropped by nearly 25 basis points during the first 6 months of the year. As competition intensifies for acquisitions, numerous major investors are shifting focus from buying to lending. In particular, mezzanine debt offers more attractive returns than outright equities. More private capital is entering the debt markets, in general. Expect further pricing compression, as a result. Overall mortgage spreads remain extremely tight by historical standards as high-quality, lower leverage properties attract pricing approaching the double-digit range. However, conventional properties are priced within the mid-100 basis point range. September 1, 2003 The Real Estate Capital Scoreboard September 2003. After hitting a 45-year low in mid-June, treasuries have risen faster than any point since 1987. Rates steadily climbed throughout August, remaining flat during the last 2 weeks. Current rates reflect the similar levels of July 2002. Yet mortgage spreads continue tightening as funds are abundant. The 5-year treasuries widened in contrast to 10-year notes, creating an opportunity to capture more attractive longer-term debt. Equity capitalization rates still remain relatively low despite interest rate increases. Tight supply and lack of new construction keep pressure on pricing. The Real Estate Capital Scoreboard October 2003 October 1, 2003. With the exception of July and August, fixed-rate debt is nearly identical to April levels. This month represents the average for most of the past year. However, last month long-term rates dropped by about 50 basis points, while short-term indices remained unchanged. In addition, the real estate equity markets remain competitive at the same levels seen throughout the past quarter. In summary, overall Treasury spreads for mortgage pricing are at 140 to 200 basis points over comparable term Treasuries. These rates translate to historically low levels of 4.25% for 5-year maturities and just over 5.25% for 10-year debt. As has been the case throughout the year, current capital markets are severely oversupplied. Overall debt markets are attracting commodity pricing as mortgage spreads compressed by 20 to 30 basis points in recent months. November 1, 2003 The Real Estate Capital Scoreboard November 2003. Even as property performance lags, equity pricing remains at record low levels as attractive financing rate and terms abound. Now, low leverage, prime quality financings attract spreads below 100 basis points. On the equity front, buyers are aggressively exploring alternative realty capital structures including mezzanine, preferred equity, new construction and other non-conventional property types, in order to generate production volume. Mezzanine financing is an attractively priced option for a higher leverage fundings. Pricing is generally within the 500 to 900 basis point range with overall yields of 11% to 18%, IRR, based on holding periods equal to, or less than, the senior debt.
December 1, 2003 The Real Estate Capital Scoreboard December 2003. November closed as a relatively uneventful month, as far as interest rate movements are concerned. Treasuries fluctuated within a quarter-point range throughout the month and settled at nearly identical levels from the previous month. LIBOR increased by a paltry 5 basis points on news of an improving economy. The 10-year mortgage represents the best value in comparison to shorter-term permanent debt. The spread differential between 5 and 10-year treasuries is at the narrowest gap seen within the past 12 months, below 100 basis points. While treasury rates are relatively flat, mortgage spreads continue dropping. Prime real estate financing opportunities attract capital well below recent rate ranges. In some cases, lenders will provide full leverage for Class A assets at spreads of as low as 75 basis points over comparable term treasuries.